Bitcoin, and I think this scenario that I'm about to show you in this video might give you a very clear picture of what to expect. Welcome back to the webisode, guys. I hope you're ready to put your booty in a jacuzzi after this massive bull cycle, but we have something very, very interesting to show you on these long-term charts, and it is extremely reminiscent of the last time that we broke the 786, the last time we came down to this key moving average, the exact same time period, which is absolutely insane, and a few other things, and we're going to get into that in this webisode. Now, guys, before we do that, I don't think patterns repeat 100%. As we were saying last week, I didn't think the fractal that had us trading, I think it was like above 11K until the very end of September was going to repeat, right? And it didn't repeat. So we were correct about that. I just didn't think it made a lot of sense. We were following it until it collapsed. And I was very thankful that it did because, for one, it would make the space kind of predictable for the next few weeks and very boring if it were to follow exactly what it was being predicted by the fractal. Now, huge, we don't have to worry about that anymore. We haven't had to for the last few days after we broke out of that. But now this is absolutely very key, so I'm very excited to delve into this in the webisode. And as well, we're going to be covering some shorter term technical analysis in this webisode, guys. So huge, if you're new to the channel, make sure to subscribe, turn on post notifications so you get updated when we upload absolute explosive juice-episodes like we have for you here today. And as well, guys, if we can hit, let's do 1,400 likes, because we've been doing pretty good on likes. If we can hit 1,400 on this webisode, we'll be giving another one of these ledgers away. These alts rallied into about January 15th of 2018. But for Bitcoin, the high was right here, right around 20K. However, guys, as you know, myself and many other people don't believe we have to reach 20K before getting explosive. We think, or at least I think, that we want to break 14, and after 14, maybe even like 13.5, after breaking that, that is when the real explosiveness begins, and I think we'll blow past 20K. We basically have no trading volume around 20K anyway. That was like a blow off top. We did not really trade there at all. I think we had like less than 2 weeks of trading above that, right? So with that being said, this indicates for me the doorway to absolute explosiveness, which, as you can see here, we just tiptoed all the way up to, right? Just recently, back the very middle of August, got all the way up to like 12.5, almost 12.6, and then got a sharp rejection. So let's take a look at this. If we actually just pull out the Fibonacci retracement here, go from the top to the bottom on the bodies, you see this, that the 786 is basically right where we got rejected, which is basically right at 13.5 or 13, that entire area right there. And you see what we're facing right now is the golden pocket, right? So that's basically at the top about 10.3 down to about 9.7. Wow, so strap in and strap on because we're about to sizzle your biscuits here, guys. So not too interesting so far, right? Now let's actually go back to the last one, okay? Now you might think you've heard this before, but this is actually pretty unique. And actually, before we do, from the very top to where we are right now, let's see how far we are into this. I already have it there, but let's just do it on the screen. Let's use this tool. Okay, so let's do, middle of December. We'll start right at the very top here, basically, and pull it all the way over to where we currently are. That's about 990 days, 980 days roughly, depending on which one of these you draw it to. So, a few weeks under 1,000 days, right? So right in between that 970 to like 990. Now, if we do the same thing from back here, right? The blow off top here, the highs here of back in December 2013, exactly 4 years to the day, basically, of that previous cycle. We draw it from here, and then we go all the way to where let's just mimic it, right? 980 days roughly. So 980 days, 990 days roughly brings us to right about here. Now, why is this important? Okay, for one, what happened around that exact same time frame is we came up to the 786 of this retracement. Okay, so we're on the weekly chart. We're going to draw it from the bodies just like we did in the most recent cycle in the bear market that we're currently exiting, and we draw it down to the bodies of this. So what you see here is a very strong rejection off 786, right? And we come all the way down to this golden pocket right here, and ultimately we find support, but only after having a very strong wick all the way down actually to this 50-day moving average. Okay, so this is one
of a little league game tonight. It is not our first game, but it's our training him in the switch hitting thing. About on the right-handed side, we're at about 85% as far as consistency on that right side now. And so he hasn't I'm waiting for him to get that first hit on the right side of the plate because that's where he has the least confidence. That's where he's done it the least. As soon as he gets that first hit, it'll be on like Donkey Kong. I guess we'll take it, but he hasn't. I'm waiting to not follow the stock market down. Everything remains somewhat stable today in crypto. And I think that's a good sign. Now, I saw this from Gold Telegraph. Central banks are the definition of power, unelected academics shaping our monetary futures for better or worse. This is not me bashing them. This is just something to keep in mind. The echo chamber that has been Kitco, Ron Paul, who is interesting to listen to about this topic. Ron Paul was interviewed by this guy on Kitco. When was this? I don't see the date. Okay, yeah, it was today. So listen to this clip from Ron Paul. He hits it out of the park on this.
News coming out of Jackson Hole. The Federal Reserve has changed their inflation targeting mechanism. Before, they wanted to maintain a 2% inflation target. Now they want to average a 2% inflation target. How would you define this difference, and why do you think they're making the switch?
Well, I don't know if they know what they're doing, and they're struggling, and they're making the assumption that anybody who cares about finance, especially from a free market viewpoint, they figure nobody knows what they're doing. I think they're struggling. This whole thing, I've made fun of this 2% thing that's been going on for quite a few years, because for me, who believe in sound money, that means the deliberate policy of our government is to steal 2% of the value of the dollar on purpose.
Exactly.
And now it's becoming more desperate to have inflation. For them, the inflation is of the rising of prices, which is a consequence of inflation. If they want to talk about real inflation, they have to talk about what the Fed's doing and what the money supply is doing. So this idea that their plan of just saying we're aiming for 2% inflation and we're frustrated because we can't get the prices go up. Well, I think that's a fiction too. It depends on whom you're talking about. The average person has an price inflation rate much higher than 2%. And it's just trying to get people to understand, free market economics from one of interventionism, because, they print all the money. If you accept the fact that that has something to do with inflation, you say, well, where is it going? There's no evidence. Well, what about a stock market? That's an evidence that there's inflation. What about bond prices? So it's out there. And this idea that their policies aren't creating enough inflation, what we have to do is average it. So if we're only down to 1%, we have the license to go up to 3% or 4%. There'll be a day, I'm predicting, that once they get their statistics that measures CPIs the government way, they won't know how to turn it off. That happened, and I remember it well, in the 1970s.
Exactly. They want to get this to where they can steal 3% of your purchasing power instead of just 1 or 2. I mean, he couldn't have said that any better. Jonathan D. Sent me this, and this is interesting too, because this is a guy from Morgan Stanley. And as I've told you 1,000 times, before this is all over, now remember, Morgan Stanley and the boys, these are the guys who are on the side of all these central banks, and they've been towing the line for 50 plus years. And now along comes crypto. Let's listen to what this guy from Morgan Stanley says. Now that they know, and they knew for the last 10 years, they knew that they were blowing a bubble into the stock market. And now these guys like to have their cake and eat it too. And so now this is what they're going to say.
Gold then, not a traditional commodity clearly, but clearly at the same time people are investing in gold for many of the things that you've discussed, whether it's concern about lack of control over monetary policy and the implications. We've also seen a lot of, particularly Americans, buying into digital assets, cryptocurrencies. What do you make of these two things, Rashir?
It's a generational thing. I think some of the older lot are still buying gold, and some of the younger ones are, the millennials are buying more of the Bitcoins and the cryptocurrencies, as you put it. But generally, I think what that's telling you is that there is this lingering feeling out there that given what central banks are doing in terms of printing so much money, there is a search for alternative assets. So I think that these assets could keep doing well. Gold in particular does very well when interest rates adjusted for inflation are negative. And I see that environment carrying on for a while, because even when inflation comes back, the central banks are going to be much, much behind the curve before they do anything about it. So yeah, gold is a very speculative